Welcome to ARGUNAS Learn. Last time, we talked all about the different kinds of investment risks out there. But, just spotting a risk isn't really enough, is it? You need a solid plan to handle it. So in today's explainer, Module 1.5, we're going to build that exact plan. We'll dive into the key strategies and measures for managing investment risk, so you can go from just watching the markets to being a proactive, really intelligent investor.
So here's what's on the docket today. We'll kick things off with the why. The real reason we even need to manage risk. Then we'll jump into the how with 3 major strategies. After that, we'll look at the tools we use to actually measure risk, see how all this stuff plays out in the Indian market, and then wrap up with a sharp focus on what you absolutely need to know for your NISM exam. Let's get right into it.
Okay, let's start with the #1 rule of investing. It's simple. Returns and risk are basically 2 sides of the same coin. If you want to earn a return, you just have to accept some level of risk. The whole idea of a completely risk-free return? Well, unfortunately, that's just a myth.
So that begs the question, right? Is it even possible to invest with absolutely zero risk? The short answer is nope, not really. I mean, even something that feels super safe, like a government bond, still has risks, like inflation just eating away your returns over time. This leads us straight to that classic risk-return trade-off. If you want higher potential returns, you've got to be prepared for higher potential risks.
And this brings us to a really important idea. A smart investor doesn't try to get rid of all risk. That's kind of like hiding your money under the mattress, where it doesn't face market risk, but it's guaranteed to lose value to inflation. The real goal here is to understand your risk, measure it, and then manage it intelligently so it lines up perfectly with what you're trying to achieve financially. So, if we agree that risk is just part of the game, how do we play it smart? Well, let's build out our investor playbook. We're going to look at the main strategies you can use to get a handle on risk. Think of them like different players on a football team. We've got 3 primary strategies in our playbook: avoidance, taking positions, and diversification. Now, to make them a bit easier to remember, let's call them the defender, the striker, and the team player. Let's break down what each of them does. First up is avoidance, or our defender. This is your first line of defense, and the rule is incredibly simple. If you don't understand an investment well enough to explain it to somebody else, you just stay away from it. Simple, right? But what's the catch? Well, it's opportunity cost. If you play it too safe all the time, you might miss out on some really great chances for growth.
Next, we have a much more aggressive strategy: taking positions. This is our striker. This is all about actively trying to predict where the market is headed, hoping to score a big win. For example, if you're sure interest rates are going to fall, you might load up on long-duration bonds, expecting their prices to shoot up. Now, the potential rewards here are huge, but so are the risks. If you get that prediction wrong, the losses can be pretty painful. This is a high-stakes game. Definitely one for the experts, not for most of us.
And our third player is diversification, the team player. This is that age-old wisdom: don't put all your eggs in one basket. It's about spreading your money across different kinds of assets, some in stocks, some in bonds, maybe some in gold, or across different companies and sectors. What this does is it cushions your entire portfolio if any single one of your investments has a bad run. It's all about teamwork inside your portfolio.
Now, here's the absolute key thing to remember about diversification. It's an amazing tool against what we call unsystematic risk. That's the risk of a specific company or a particular industry doing badly. But, and this is a big but, it can't protect you from systematic risk, things that affect the entire market, like a recession. So diversification strengthens your team, but it can't change the weather for the whole game.
Now, to use any of these strategies well, you first have to measure the risk you're facing. It's like that old saying, you can't manage what you don't measure. So let's open up the technical toolkit that investors use to actually put a number on risk.
We can basically sort these tools into 2 main buckets. First, we have measures for credit risk. That's the chance a borrower won't pay you back. And second, we have measures for market risk, which is all about how much prices jump around. We'll do a quick overview of each right now, and don't worry, we'll go much deeper in future explainers.
Okay, for credit risk, our first tool is credit ratings. When you buy a company's bond, you're lending them money. So, how do you know if you'll get paid back? Well, credit rating agencies like CRISIL and ICRA do all that homework for you. They check out the borrower's financial health. And a high rating like AAA means the risk of them defaulting is super low. A lower rating, though, is a signal to be a bit more careful.
Another really clever tool is something called the credit spread. This is just the extra interest a corporate bond pays you compared to a super safe government bond. Think of it as a risk premium. If the spread is wide, it means the market thinks that corporate bond is riskier and is demanding a higher interest rate as compensation for taking that extra chance. All right,
Now for market risk. The most common measure here is standard deviation. Now, don't let the name intimidate you. Just think of it as a measure of how wild the ride is. It tells you how much an investment's returns tend to swing around its average. A high standard deviation means more volatility, more risk. It's the difference between a crazy roller coaster and a calm, scenic train run.
And finally, we have beta. Beta tells you how a stock or a portfolio tends to move compared to the overall market, like the Sensex. So a beta of 1 means the stock pretty much moves in sync with the market. But a beta of more than 1, that suggests it's more volatile. It tends to go up higher when the market is rising, but it also falls harder when the market is dropping.
Okay, so that's all the theory. But how does this actually play out in the real world for everyday investors here in India? Let's take a look at risk management in practice.
This table is a perfect summary. When an investor avoids complex products they don't understand, what are they doing? They're using the defender or avoidance strategy, which is very sensible. When someone tries to time the market perfectly, that's a high-risk striker move. And for most of us, the most practical and powerful way to be a team player is through diversification, and a really common way to do that is by investing in mutual funds. Now, for all of you studying for your NISM certification, this next part is super important. The exam isn't going to ask you to do a bunch of complicated math. What it's really going to do is test your conceptual understanding of these ideas.
Here are 3 really common traps you need to watch out for on the exam. First, believing that diversification gets rid of all risk. It doesn't, it just reduces it. Second, thinking that the avoidance strategy is always the best choice. Remember, it comes with an opportunity cost. And third, confusing measuring risk with getting rid of it. Using a tool like beta just helps you understand risk. It doesn't make it disappear.
So here's your key exam tip from us at ARGUNAS Learn. Focus on the why. Don't just memorize definitions. Always ask yourself, why would an investor diversify? What is the whole purpose of a credit rating? If you understand the purpose behind each concept, you'll be ready for pretty much any question they can throw at you.
All right, let's do a super quick recap of the main points. 1. Risk can be managed, but it can never be completely eliminated. 2. The avoidance strategy is safe, but it has that opportunity cost. 3. Taking positions is a high-risk game for experts. 4. Diversification is the most practical tool for the vast majority of investors. And 5. To manage risk properly, you have to measure it first.
And that really covers the essentials of risk management strategies and measures. If you found this explainer useful, please do support ARGUNAS Learn by hitting that like button and subscribing. And now for the important disclaimer. This video is for educational purposes only. It is not affiliated with, endorsed by, or sponsored by NISM, AMFI, or SEBI. Mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing.
We'll leave you with a little something to think about. Now that you understand these 3 core strategies, which one do you think best fits your own personal investment style? Are you more of a cautious defender, an aggressive striker, or a steady team player? Let us know what you think in the comments. Thanks for joining us on ARGUNAS Learn.